Good morning, everybody. How you guys doing? Let the man make a coffee or something? No, I was just waiting for the YouTube intake server to let me start the fucking stream. Morning, morning, Steve-O. How you doing, man? 1 minute late. Oh, you'll live. What's up, Lugs? I miss you too, man. When are you coming back? Really? Bip Solar Bear? Hey, Junjun. Next quarter? All right. Like quarter 1, 2024 or quarter 4, 2023? Why are we starting out with the most bearish time frame in the history of time frames? It's the broader outlook, right? Sorry, I was running late, but I'm here now. You can start. There we go. Popcorn traders in the house. We're good to go, everyone. Let's talk about the elephant in the room. Which elephant is that, Hugh? I've spent a little bit of time on Twitter and Reddit this weekend, and according to them, this is bullish. I think the only Japanese data we have to worry about right now is the 2-year. But tomorrow night we have the rate decision. So there's a 2-year auction, and then we've got some EU reports in the morning, and then tomorrow night Japan has a bunch of shit: unemployment, retail sales, and their interest rate decision. Yeah, I can touch on cat in a little bit. 3-month drop in a row so far. I mean, October's not over yet, but you know, it's currently down 4%. How fucked am I on my GME position? I don't know. What's your cost basis? Fortunately for you, GME is almost too illiquid to really feel the effects of the market coming down hard. Although it is being shorted again, so like I would imagine you could expect things to go slightly worse from here. I feel like FinTwit and FinTube is super bearish right now. Yeah, but those people are all idiots. Who cares what they think? If that's your approach to market analysis, you're going to lose a lot of money. Banks don't seem that worried yet, although there is quite a lot of flight to T-bills lately. At least among the private investor class. I didn't see your new cost basis. Did you lower it? Good for you. If we hit $10, I'll think about doubling down. I might consider that at like $5 or $3, but I wouldn't do it at. If this drops below gamma neutral, I'm probably gonna sell everything and then just wait. Right now, there's no. Yeah, it's bipolar bear. Right now, there's no guidance, right? Like, there's no potential for growth. So there's nothing that GME is gonna do that's gonna drastically change their like valuation. I think if it, yeah, I think if it drops much more and I lose out on the annualized yield, I don't have any reason to keep it. We do have some big earnings this week. Yes. Thank you, Carl. I believe we have what Apple's later this week, Friday, Thursday. I don't think there's I'm not sure if there's anything else. Uh is there? 1 second. Is that it? Is there is there no isn't there one other? I'm looking at this fucking thing, I don't see anything. Nvidia's later though. So you're just Apple this week. I like Airbnb, AMD. I guess Cat has earnings this week. Cloudflare. Fubo this Friday. Fubo's an anticipated earnings release. RC's gonna wait for the market to crash, then buy Cat with their cash on hand. That'd be the smartest thing he ever did. Nvidia 400 level, potential head and shoulders. Gross. If Nvidia breaks down through the 400 level, it's a problem, but it hasn't yet. Arguably, you've got a test of the 400 level and then a higher low. It's not necessarily that bearish. I don't think Nvidia will fall hard till they miss guidance. Not really hard. I could see it pulling back maybe to like 370 again, but I don't think it'll fall. I don't think it'll like fill the gap down unless they miss on something. I got a YouTube suggestion for the best chopped cheese in XYZ. I see now what you mean. They're disgusting. Airbnb, well, those aren't going to be good, right? Airbnb slipped 120 badly. I know. I'm short Airbnb. I guess we could go over the current levels on it a little bit. So we're now below my like long-term price target, but there are more to the downside here. There's actually some support. Fuck did I just do? There we go. There's actually some support at this level, and we'll probably hold here until earnings. But if earnings doesn't shake out favorably, I mean, the next stop down is like 104. I think they're still trading at like a ridiculous PE. Yeah, they're still trading at like 33 forward PE. So I don't think there's any worry about it being overvalued. I would say there would only be a concern if they were to beat on earnings. But if it bounced, that would just set up another opportunity for a big short again, right? Do you think Amazon will come back down to its pre-earnings level like Microsoft did? Probably. I mean, if the market continues down, yeah, absolutely. It can't, like, none of the Mag 7 can really individually sustain a sell-off in the rest of the Mag 7, right? Eventually, like, the market cap reductions across ETFs will lead to them being sold as well. And you get that, like, leveraged gearing effect that kind of sinks all ships. What's a realistic bounce point on Apple? I've been targeting 155 as a bottom for my current puts, although we're in a decent descending wedge at the moment. I mean, Apple's projections for this earnings were not good. I know a lot of people didn't really listen to their earnings call last time, but it doesn't look great. I would say that on the low end, I could see Apple hitting like the mid 100s over the next couple months, especially if earnings miss, right? What's the expectation? So they're looking at like $1.39 EPS with 89 billion in revenue, which is still an increase from the prior quarter. So analysts really aren't expecting Apple to be very truthful about their guidance, which seems like it could surprise very easily to the downside. Over a longer period of time, or in the event of like an adverse market conditions or adverse market event, I would say that Apple has plenty of ground to give. So yeah, this was like kind of where my short target for Apple fell, like my prior PT. But yeah, I could see like 152 or 142 on like missed earnings, if they miss earnings again, or if they lower guidance even more, which is possible. However, I mean, whenever you're considering these mega cap earnings, your best bet is to either play them from a neutral position or just stay the fuck away from them. Despite what the evidence supports and the macro conditions, taking a bearish bet on them can be extremely risky because they have very diverse revenue exposure, and their accountants are more than capable of finding profits where one would not expect them to be found. So be wary of that, right? Don't take any just purely directional position on them because you can just lose a ton of money. What ETF is Airbnb in? Spy? I thought you were on the same Twitter page as Gad because he uses same big words you do. I still don't know who that is. But okay. Yeah, three people have brought him up to me over the last like 3 days, and I have no idea who he is. I've done okay over the last few weeks. I need to move some cash into my long-term holdings. I'm keeping some in cash, but I don't have a lot of dividend stocks. What's the deal with AMKBY? So I think they're relatively cheap right now. I think as supply chains start to heal, their business will do better and their stock price will reflect that. They pay out a huge percentage of their cash flows as dividends to their shareholders once a year, which is awesome. And yeah, that's kind of about it. I mean, that's why I own them at least. So I think they're a little undervalued. I mean, it's not something I've done a write up on. There's some risk with shipping, especially with all the like conflict going on right now that could really really hamper things. But yeah, I don't think Merck's going anywhere. So I feel like it's pretty safe. I can accumulate dividends on it. I had to dump SPY gains into something, so SPX gains. Apple also sinking in China. Yeah. I hate Apple as a company. All they do is rehypothecate cell phones, and they're the wealthiest company in the world. I don't know if I'll ever open a long-term Apple holding. I think Apple's a bit of a value trap. I think far too much has been priced in. I don't think they'll be able to maintain their, prior revenues into the future. Not without significantly changing their business model and or product line, right? And I don't see that happening under Tim Allen. So yeah, for now, I think Apple's pricing in far too much future valuation. There's probably a good price to buy it, but I don't think 168 is it. Maybe if it went back to like 100. I did the GME tips earlier. It's being shorted. Shorted PayPal back in late September. How much more can I squeeze out till December? I'm worried about earnings cutting into my profits. I don't know. It seems like every time their CEO opens their mouth, the price of the stock drops. But I mean, you can hedge earnings if you have a lot of time on your puts, or you can just take some profits and let the rest run, see what happens with it. Nope, I didn't send you a friend request. How's Airbnb going to explain away their business model being banned in several states? I mean, it's going to affect their revenues, right? I think far more concerning than it having been banned in other states is it being banned in more states in the future, right? Lead lag report, one of the fin twits you commented on. I don't know. I think I responded to something somebody else messaged, but I wasn't responding to the original poster, which I think was the dude you're talking about. The reason it's concerning that Airbnb is banned is because of government overreach. It's not overreach. We have a housing crisis, especially in some of the areas where Airbnb is being banned. Do you see property as a valuable investment? Defensive. Valuable, I don't know about, but defensive. I mean, each property can come with its own risks. I agree. I don't really see it as that important. I mean, if the market really shits the bed and we start getting like bank auctions for homes, like 50% below like local comparables, then maybe. But like back in like 2010, 11. But unless we see something like that, I wouldn't really be very interested in property. Yeah, Tim Allen. If an ETF is pushing up when the overall market is going down, that means it's heavily shorted and covering is happening. I've been watching PBI. I mean, I'm not sure. PBI is not an ETF. What ETF, Paul? Apple needs to go back to being the go-to art and music creation platform, which they ceded to third parties. I think that's out of their like capacity now, right? With generative AI. Like I mean everyone's just going to start using those tools. Arguably and Adobe's probably way far ahead of Apple on the curve there. So I don't know if they'll get that back. I mean, right now they're still the go-to for like digital media, right? But they could easily lose that. So yeah, I don't really see a very bright future for Apple. I guess we could talk about Cat. Someone wanted to comment that they crossed the 200 MA. I mean, I don't think that's as important as if Cat breaks its long-term downside resistance. Um, it could drop pretty far. It's also got its dividend. Nope, dividend's done. Earnings coming up this week on Tuesday. That might provide a little bit of support. I don't think their earnings expectations are very high this quarter, and they've beaten everything but last quarter one for like 14 or something consecutive earnings. So the chances of Cat beating are pretty high. They're still benefiting from the infrastructure bill, right? Dow's been sharding itself. Yeah, yeah. Dow's getting hit. Well, I mean, Dow, RSP, small caps, mid caps, they're all falling, right? The only thing really still propping the market up is people acting like tech is defensive. We kind of looked at like the heat map on Friday, which was ridiculous, right? Like the S&P heat map. Everything's just being floated by a couple companies. And then if we go to like performance like the last 3 months, even those are starting to slip, right? So we've got like UNH and Lilly holding shit up. But this doesn't look very good. 6 months, it's a little bit better, right? But we're starting to see like the cumulative effects of selling on all the smaller companies in the S&P. And like, Apple's now down across 6 months. Um Microsoft's pulled back a significant amount. Google has. So Meta, Amazon, and Nvidia kind of still holding up the year-to-date gains. I guess Tesla too. But as we fall further, this will continue to slip, and those companies where all that interest is compounded, when they do drop, are going to drop very very fast. JPM CEO selling shares is all the bearish bias that I need. I mean, he's getting older. He might not last out another he not be able to survive like another financial crisis, right? Before he retires. Makes sense. At least from a planning position. But it is bearish. Can you talk about selling spreads at resistances? Bull, bear, call, put, credit, debit. Which one requires more margin? Well, debit spreads don't require margin. I want to start paper trading this strat. So something you can do on big blow off runs. Yeah, we'll just use SPY. It doesn't matter, right? Let's go a little more granular, but something you can do on big blow off runs on intraday or drops on intraday price movement is like when you get the test, right? Like high volume moves, and say you don't get an entry at the bottom. On the test, you can sell the in the money. Well, in this instance, the in the money bear spread. So credit spread. So let me zoom in a little bit here. So you can sell the in the money spread. So say here you sell like the 413, 412, right? And you should get like higher than, like greater than 60% credit on risk. So this spread would have $100 risk, right? Your target is to get like $60 or more. And then what you can do is when it drops, you can capture the profit, right? But you know, say it only drops to like here, right, where it did. You can close the short call, and then on the next move up, so like if it finds stability and you think it's going to move back up, then you can close out the long call. And you can do a similar thing here on like downside tests. You know, you can sell the in the money put spread, right? And this gives you a little less exposure to the price action, but you get a, thank you, JFresh. But you get a benefit off of the price movement, right? And so it can be a way of scalping without putting down, you know, $9 of exposure, right? Especially on SPX, where because of the high volatility, getting at the money exposure is really expensive. And by selling it in, you know, PDT accounts especially, your net credit, and so that frees up your liquidity to later hedge that position if you need to, right? So say that you know position falls deeply out of the money, right? Say so actually it would have here if you'd sold this in the money spread, and then it fell out of the money here. You can then box that spread without using a day trade, or you could hedge it. Probably just box it, right? You would sell the like 411 or buy the 411, and then if it bounces, you know you're covered, and the profit you made is protected. And that works on upside tests or downside tests. I mean, obviously, ideally, for efficiency's sake, you would, you know, you would be going like long here. That's another thing you can do is you can use it to like lock in your scalp. So you can like go, say you go long here, right? And then you hit resistance here. You can then sell you can then sell this against it. Like you could sell like the four, say you go long at the 412. You can sell the 413, right? And then lock in your profits, or you can sell the 411 and lock in your profits. So just fun way of handling that. So you can spread out your winning call or your winning put. The old Farmville strat. I find it hard to believe that he's doing that efficiently. I thought Farmville strat was to, hey, it's okay. I know you're there. I find it hard to believe that you're just not buying these calls and puts. I've watched you trade for a long time, and I feel like you're still more prone to buying these, like, you know, buying everything that the price doesn't trade in for the day. Definitely buying ES futures options. Jesus Christ. I don't know what it says about the system that they gave you approval for futures. What's up, Hodge? Yeah, Friday was crazy. The end of day Friday was fucking nuts. That was yeah, from like noon on, that price action was insane. The battle was crazy. Terrible to trade, but really fun to watch. My liquidation into end of day was glorious. Top of the chain. Oh boy. What did you do? What am I prone to buying? GME at too high of a price. Bounce into the Fed decision? Not necessarily. I mean, what's our current like Fed Watch has got us at 2%. 2% chance of holding, cutting. So 98% chance to hold with a 2% chance to cut. It'd be funny if JPAG just raises rates and forces the swaps market to reprice. I mean, like, okay, so I think bond yields have gone up enough that JPAG's got a little bit of, he's got a little bit of breathing room, right? But he'd also have to trust that the volatility in the bond market isn't fleeting, right? And that it's going to stay volatile. He may not, right? I mean, the Fed may not take that risk. And then PCE's up, CPI is expected to be up. The labor market's strong, GDP's strong. There's no reason that he couldn't raise rates. The Fed really wanted one more rate increase this year. They might just do it. And even if everyone's just convinced that they're gonna pause again, right? It's not gonna be a dovish pause, right? It's gonna be hawkish again, right? Pressures on yields are gonna continue. The pressure on the dollar is gonna continue because nobody else's economy is getting any better. And we're just in the same situation. So I'm not really sure that I'm not really sure there's anything bullish there, that at least not that exceeds the current extremely bearish positioning, right? Would selling $11 to $12 GME CSPs a few weeks out be too risky considering GME share price is dropping so fast due to shorting and the extreme bear market? Well, we're not in a bear market yet. We're in a correction, but it definitely carries some risk. I mean, are they even worth selling? Like, is the yield worth it? I feel like there's stocks you can make way more money selling CSPs on. And selling CSPs in a downtrending market is stupid. It's peak stupidity. Because if the market were to crash or correct further, right, you could end up holding bags for years that you overpaid for, right? Underwater bags for years. That would suck. Generally, the wheel, which so many people love, is good in markets where volatility is low, not where volatility is high, which is unfortunate because it means that, you know, you get less premium, but far less risk. We're gonna do nothing, but our arms will be crossed and we'll be frowning the whole time. Yeah, it's kind of like a timeout for the market instead of a spanking. My Robinhood account is negative 98.33, and I just took a 10K loss selling my GME to get more money to trade. Fucking Christ. You're a survivor, Farmville. Long after the market should have killed you for your terrible decision making, you've managed to persist. Like a cockroach, or the wasps that live in your walls. Or the cockroaches in your walls. Should you expect anything from the BOJ rate decision given the yen price action the last week? So I don't think so. And here's why. I don't expect the Bank of Japan to take any monetary policy action outside of maybe some more yield curve control until the Ministry of Finance, whose fiscal responsibility is the yen, depletes more of their reserves. So the Bank of Japan just took action to the tune of like $28.9 billion on Japanese bond buying in order to affect that YCC control policy. It wasn't very effective, obviously, given where the yen's right back to. But it benefits people to continue to pressure that trade. So yeah, I think more biding their time and waiting for the Ministry of Finance to step in open market actions, and then I think once the Ministry of Finance is kind of uh, deployed all of their assets in attempting to stabilize the yen, then the Bank of Japan would step in. But I think right now they're waiting to confirm that their inflation is indeed on the rise, and so, you know, obviously they don't want to take any kind of drastic action like moving to a zero interest rate or moving to a positive interest rate, um, without really confirming that, you know, their inflation is going to continue rising, which it very likely is, right? Like eventually they're going to get backed up against that wall, but they have a lot of time they can buy before they do. Underwater bags for years. I already did that with GME. No thanks. Yeah. Instead of buy riding TLT, if the interest rates are likely to go up, would it be a bad idea to sell CSPs on TLT as long as I used a broker that paid interest on cash uses collateral? Why not just spreads? Do you really want to own TLT? Like you could just sell like bear call spreads, right? Less capital intensive. I think there's a, I think there's also a, isn't there like a covered call TLT ETF? Hey Greg, I've got a few November 17, 42.25. I'm having a tough time deciding when to take profit and reposition. What's your thought process on when to take profit and reposition? Usually at major resistances. Once I've confirmed a bounce, I'll just kind of close everything out. But up until that point, I'm usually hedging. I mean, we're at a major resistance right now. And with the Fed meeting coming up, we may not see the underside of 4,100 until later this week. The defense of it on Friday was extremely strong, so we at least know it's a level that bulls are very unwilling to lose. That doesn't mean they won't just lose it, and we won't just fall further tomorrow, especially with the collar puts starting to pick up so much delta in Vega. But it's definitely a level they'll try to defend it. Even if we lose it, they may try to bounce it back on capitulation, right? Volatility is getting high, and the potential for like upside squeezes is picking up. So yeah, gains on longer dated puts, especially deep in the money ones, can get wiped out very quickly. If you're not carrying a hedge for the upside, you probably should be. And then as far as repositioning goes, it's usually better to wait until we found a support and we've gotten some kind of like capitulation driven rally in order to re-enter positions, if you're going to continue to bet on the downside. Although we did kind of just have one of those, and that's something I wanted to talk about actually, is that a lot of the bulls on Twitter are kind of going on about how like we need a relief rally, but we kind of already had one. If you look out here on the weekly, right, for most of the beginning of October, we had a pretty strong relief rally, right? It was almost 2.5 weeks. It just failed, right? We were all watching that to see if it would fail. And if you look a little more granularly on like the 1 day, we really haven't been going down that long, right? We had like 3 days of downside, we had 2 days of recovery, and then 3 more days of downside. I don't really think that we need a relief rally here. I think there's far more than enough interest, far more than enough negative delta and gamma, and I think IV is high enough that we could just continue to drive down with plenty of liquidity to the downside. I mean, relief rallies usually occur because you've kind of maxed out the downside liquidity, right? There's no more sellers. You've run out. And then in the absence of sellers, there's buyers, right? So, but I think there's tons of liquidity to the downside still. I think we haven't even begun to really hit the levels where we would see bearish positioning run dry, right? And we know that there's short puts sold at 4,100, 40.75, 40.50, 40.25, 4,000, 30, like every 25 increment all the way down to like 3,600. So there's always liquidity because those positions going underwater are going to force the to hedge, right? Which is going to provide additional downside liquidity, or they're going to capitulate, which is going to provide even more downside liquidity. So yeah, I don't think that case is really valid. I could see there being a slight bounce or some stability found into the Fed meeting because people are going to want to neutrally position around that. But yeah, we're only 10-ish% down from the top. Why not another 10%? Well, remember the first 10% kind of begets the next 10% and so on, right? Fear drives more fear, and selling drives more selling. It's just kind of the way the market works. Everyone who thought, oh, it's fine here, you know, back in like September after the big drop in August, you know, they're going to be a lot more scared now. And everyone who didn't sell here, like, and you know, these missed opportunities on the upside moves are going to keep reinforcing that fear that, you know, they're not going to get those valuations again, at least not anytime soon. And margin contraction due to the credit environment is a very real threat. I mean, we're trading with S&P at like forward PEs of like 20, which even now, which is fucking ridiculous, right? We've got a terrible credit environment. We've got higher for longer. All of these companies that rely on debt to finance growth are fucked, right? And we're valuing them like they're going to grow for the next 10 years exponentially. And that can't last. The ZERP era of like 2010 through 2023 is dead. And there's a really good chance we don't see zero rate interest policies again for decades. We honestly sliced through the 200 DMA. Yeah, we did. I could turn that on. That's right here. Yeah, we went right through it. And now we're moving towards like a death cross, right? Where the 50 MA comes below the 200 MA. Gambler's fallacy. Yeah. I'm currently not exposed to the market at all over the weekend, and these bearish thoughts make me want to FOMO. I mean, FOMO is just bad, right? Don't FOMO. Just enter your positions with a plan. FOMO's stupid. That's how you lose money. Almost every time. Higher rates will be better for our future. 0% rates was super risky. I don't disagree. I do think that a higher federal funds rate over time benefits us. But first, it's going to cause a lot of pain. Later, Lugs. Have a good one, man. Did anybody have any questions about anything else? Should we cover Tesla a little bit? I know some people are still short there. So Tesla finding some support at around 200. This is probably getting to the point where it's a little bit oversold. Let me check something on it. It's gotten a couple rallies over the last couple of days due to short calls closing and repositioning. But as those, you know, if those reposition, especially if they reposition at or near the money, the majority of sold calls, that's going to drive interest maybe even further down. Friday, Tesla started to slip delta neutral and then kind of recovered, bounced back into gamma neutral, and then closed down on the day. Up on the day? A little bit up on the day. Yeah, so closed a little bit up on the day. I would say that put interest is probably going to fall off a little bit on Tesla into the early part of this week. And so I don't know what the range on that's going to be. I'd have to look a little deeper, but I would say that a bounce back to trend or 220 probably isn't out of the question. But if indexes continue to correct down further, like QQQ and SPY, that's gonna put a lot of weight on any upside move here, and it will probably just continue to drag Tesla down. So I would be cautious entering at this price though. This is a pretty risky entry if you're not already in it. If you are in it, obviously you'd be looking for like a break of 212 to confirm upside or take profits. That's probably where I'd have my stop. I know most of you that are short Tesla are already very deep in the money, so you have a little bit of flexibility with your risk there, but I don't think I'd want to give up the profits to pull my risk back to like the 220 level. I'd rather just close it out. For a continuation, you would look for the rejection in this lower range, right? If it's going to get that continuation. So you might want to give a little bit of flexibility to 212, but not too much, right? And then if this is to get a continuation, we could see like, 180, 190, let's say 190 to, and then if it breaks the long-term trend, who knows? Lot of room to the downside there. For Netflix, it's continuing to lose ground. I didn't get into the longer dated shorts last week, and I would almost at this point like to see it kind of bounce back towards like 406, 410 before re-entering. But if I did re-enter on a bounce back, I would be targeting like 30. Probably like 30 DTE. I'll write this up if the entry makes itself available, which I don't think it has right now because it looks like it's still dropping. But probably 30 DTE and then targeting like the 375 range. But yeah, right now, I mean, if you're still inputs, you're doing great. If you haven't entered them, I don't think this is such a great opportunity to do so. But I'll write that up. If I see the entry, like if we get a bounce in the early part of this week and we get like an entry in here, then I'll write up the because I'll take that position. I'll probably take a short position from there. From here, if it continues down, what you could do if you really want to is you could kind of continue to scalp it with those weekly debits, right? Just at the money, and see where it falls to. Like you could try to play some of the gap fill, maybe the 380 level, and that's kind of what I would do if indexes continued to fall. Have you already gone over Nvidia hovering around 400? Nvidia hasn't had earnings yet. If it loses 400, it's a big deal. It hasn't lost 400 yet, but if it does, it can move down pretty rapidly. It might be worth it to have some exposure, but you have to watch for those like early week bounces on short call capitulation that tend to fucking wreck put buyers, especially here where short put interest at 400 is like in excess of 125,000 contracts. They're really going to want to defend that and see if Nvidia meets expectations, right? They'll defend it as long as they can. Obviously, yeah, the rest of the market moving down kind of hampers their ability to do that. But that also means that, you know, if they're going to try to defend that level, to expect big pumps on any bounces, because they're going to try to drive the price as far away from that risk level as possible, as quickly as possible. So I would say that right now on Nvidia, any upside market move is likely to be quite the push. Like if they got 2 or 3 days of flat or positive markets, indexes, I could see Nvidia pushing back to like 430, maybe even 450. Nvidia to 500 on the back of JFresh AI peeners. What's the typical DT on those that you prefer? Oh, like 0. Yeah. If I'm like, those are just intraday trades. So if I'm selling like in the money spreads at like high and low points in the day, or like big volume blowouts, yeah, those are just 0 DT. YouTube drives me crazy today. It continuously breaks up. My internet connection's totally fine. Anyone else problems with YouTube? I don't know. Spaceman. Yeah, I'm not having any upload issues, but I was having some issues getting the stream started today. So that might be part of it. Like the intake server for YouTube streaming was taking fucking forever to like register the stream as live. I think it took like 3 minutes, which is usually like 5 seconds. Lots of buffering issues. Yeah. They weren't prepared to shoot out so many ads after they forced everyone to turn ad block off. I'm gonna see if I can figure out cross streaming with the Twitch channel in case they have continued issues. And then I can just stream on both. So there'll be like a backup stream. I don't have any like contracts, so I'm pretty sure I can stream on both platforms. YouTube just isn't like Girk's face because it's such sexually explicit content. Like, hot damn, Girk. I try to tone it down, Carl, but it's hard. Feels like SPX 4100 level demanded a large defense this week. Do you think any technical buyers will come in at such a large psychological and technical level? Yeah. Yeah, we could see that. But does I mean, well, they did on Friday, right? But that doesn't mean they're gonna win. So in market corrections like this, frequently you'll see levels that buyers come in at and they think it's a good opportunity, but sometimes they just get crushed. Like just because buyers are there doesn't mean that there's going to be a bounce. They still have to outweigh the selling, and the selling is a lot. I can't wait to be a Dillionaire on both YouTube and Twitch. Yeah, I don't know how to do that part. That would be difficult. I'll probably just only have memberships on YouTube. Backup stream idea. I mean, that's why I have the Twitch channel, like just in case, right? Mostly, but also so I can play video games once every 7 months. The selling is super broad based, which is where somebody full porting Mag 7 with their HELOC is going to get crushed. Yeah, yeah. Well, my question would be, what is the velocity and mass of this falling knife? I'm gonna need a big hand to come grab it. I don't know if there's a hand big enough, because the thing pressuring this is the bond market, right? You have the bonds and derivatives market both pressuring equities down, and those markets are much, much larger. Do you think big players just aren't participating in the VIX auction window to get their exposure anymore? I mean, they don't want to add a lot of risk there. I mean, they did Friday, right? Like they were selling the fuck out of vol on Friday. It didn't get them anywhere, but they were selling it. They were trying to, I mean, they were trying to sell all the vol they could. They were selling calls, they were selling puts, they were selling everything in the auction window that anybody would come and buy, to the point where there was like no liquidity at like the 23-day strikes, right? And they had to switch from selling puts to selling in the money calls. I mean, Friday got crazy. Friday got really, really crazy. Me and Dork were watching it like intraday, like dumbfounded at what they were doing to just try to keep us off of that breakdown of 4100. And the reason is they concentrate over the last like 2 weeks. They've concentrated all of their risk at lower levels that they didn't expect us to touch, right? So they rolled down all that 4300 and 4250 risk, and they rolled it all down to 4100. 40-50, right? Hoping that we would never drop that far and that they could recover the market and, you know, continue to risk off. And they didn't get the recovery, right? They just got a bigger breakdown. So the first 2 days of this week, they really tried to push for a recovery to save these levels, and then they failed. And now those levels are seriously at risk. They're out the money, and some of them are in the money. I mean, 4150, 4175. 4200s are in the money. That risk is just underwater now. And so they've got delta risk on their upside position, and then Vega and delta risk on the downside positions increasing. It's becoming harder to sustain that. No, I mean, they were selling in the money calls. Anything they could to short vol. Selling calls shorts vol too. You can short vol by selling calls and puts. Yeah, no, they didn't really get a handle on VIX at all. Well, that's because the risk, right? The risk at 4100 is constantly attracting the market maker long Vega, right? And so every time we'd pressure 4100, the market maker would go longer Vega, and then they'd have to fight back against that again. And so that's kind of what the entire end of day Friday ended up being, was just them pushing into that risk, and then like the market pushing into that risk and then fighting back against it. Yeah, there's some technical issues, I guess, with YouTube right now. Gaff. All right, let me see what the boys are up to.
Delta neutral stuff.
Kinda, yeah.
Hey guys.
What's up, Bert?
Ooh, all kinds of charts.
Yeah, I had some. I had this. I refrained from sharing a lot of stuff with the poors over the weekend because it was just too good.
Nice.
We had to talk about it before I just exposed them to explicit content like this.
All right, let me get. All right. Good to go when you guys are.
Actually,
I'm doing all right.
Penis.
Is that where we're gonna start with the options trade?
We can. I would love to hear.
I don't know. I'm just
hear fun stuff on it.
It looks kind of frightening. I mean, well, Vega risk didn't really.
Like shit. Either we're gonna
say it. I know you want to say it.
Say it.
Everything looks like shit. We're either gonna crash or bounce.
Can we take?
teasing us.
Hold on. I'm having issues with my audio. I'm not hearing you guys very well.
Oh.
So should we speak like? So is this your eyesight transitioning to your hearing as well? Like, do you have hairs coming out of your ears?
I mean, I have hairy ears. Let's just get that out of the way.
I wanna first take a moment, I guess, before we get into that, to talk about last week's predictions. I really don't know how to assess this. I think I think I can't take the win. I was so far off in the beginning of the week. Like the first 2 days of the week were just a wash, right? Because we didn't lose the 4,200 level right away, and like my entire prediction was based on us like losing the 4,200 level and then kind of recovering. And we kind of did the opposite of that, which was we held the 4,200 level, bounced, and then fell off. Now, I will say my end of week prediction was only $2 off. But I think you guys get the early part of the week, which is the majority.
At least it didn't go. At least the market didn't go straight up and blow us all.
Yeah, that's true. Yeah, we didn't like go test. We didn't go test delta neutral or anything stupid.
Wait, Girk, everyone on YouTube is saying that we are quiet.
You're quiet?
Yeah, us.
There we go. Try that.
All right.
I turned it up more.
Penis. Testes 1, 2.
Oh, you know what I probably did? I probably turned down my Discord volume. That's why it's... Hold on.
Nah. All right.
This is a professional...
That should do it.
All right.
This is a professional stream. You need a little bit more decorum, I think, Dork.
Fine, I'll say fancier words for penis. Like phallus.
Phallus. Yeah, phallus is a good
one.
Yeah.
Yeah, so Girk,
got a lot.
Just for the predictions. How about I was right for the first half of the week, you were right or I was right for the first 2 days, you were right for the last 2 days. How about that?
I feel like JFresh was actually also pretty right through there, though.
No, he didn't get down. He didn't get gap down to move.
That's true. But his end of week was closer to mine.
Yeah, I mean, yeah.
I think it's simple. We just all get trophies.
I like that.
Yeah.
Okay.
Let's do it. We all win.
Trophies. I love it.
Couldn't be more right.
We were all right. We're just revisionist history. Just redraw the candles.
Yeah. We'll just move the lines.
Yeah, our predictions. I thought our predictions, honestly, they were. I mean, net. It looks like we really. Day. One day was weird. The rest was all right. You know.
Yeah.
But that one day was so crucial. You know.
You know, the prediction that I missed was Amazon. They had pretty good earnings.
They kind of did, yeah. I was actually surprised, but their AWS like forward revenue does not look good, especially in the increased competition environment. And that's gonna, I think that might have already started to spook people Friday.
Yeah.
I think people started looking a little deeper. And that doesn't look so hot when they're losing huge amounts of market share to like not only Microsoft but like Google and Meta cloud services. And it just seems like a big piece of, like a big pie that they're just losing slices of.
Well, the pie is shrinking and their pieces of the pie are also shrinking, right?
Yeah.
The pie being growth, right? I mean, cloud's still growing. It's just everybody priced in like 30% growth year over year for 10 years already. And so even though everyone posted stellar earnings, it wasn't enough to support the ridiculous valuations that we find ourselves at. Although they're still trying. I mean, the meme 7 is still pushing 27-28% of the SPX. It hasn't lost any of that ground.
I feel like it
Yeah.
did earlier in the week, but then it like just regained it all back as the breadth got worse.
This has happened for months now. It's like, well, pretty much through the whole summer. Every time like breadth went up, everyone's just like, breadth is improving. This is a new bull market. Everything's awesome. And then the next day, breadth just plummeted again, and nobody said anything. And then like a week later, it goes up, and it's like, oh, breadth is improving. And then the next day, it plummets. Like anytime breadth goes up like 1 or 2%, the next day it goes back down.
Yeah.
Give me a second here. I'm trying to deal with some of them. We're having some buffering issues on the stream. So
just a bunch of like time delay or something.
Yeah, I think what I'm gonna do is I'm gonna stop the stream and try to go on the backup server real quick. Give me one second.
Grilled cheese sandwich.
Or worse.
Chopped cheese.
No.
Brisket? Brisket for breakfast?
No, that'd be good. I'm saying the quality of the food that I ate was terrible.
Oh, McDonald's.
Fast.
Yeah, there you go. Yeah.
McDonald's. Okay, so we're live again. Let me know if the buffering issues are fixed. I switched streaming servers on YouTube, so if you guys could just let me know in the chat.
Puts on Google.
Yeah, seriously.
I know, right?
The fuck.
Man, and with it's on a weekend where it's like shit just looks so great, and I know we all have a lot to bring to the table to just illustrate how terrible this is.
Yeah.
Yeah, I mean, it looks bad, and everybody's chomping at the bit to catch the knife. So I hope it keeps going.
I know, me too, dude. This is like, and we were talking about this. Remember on Friday, JFresh, you were like, you were saying things that made total sense, right? With like the data we were given, where we were like, man, this is this is probably gonna recover and all this stuff, and then it just didn't. It was just, that was so nice.
But they were able to save 4,100. It's just fascinating the battle that was occurring. I mean, if you actually just were looking at it, it was kind of like, okay, it went down and then it was just flat the rest of the day, but it was like gloves off.
It was.
It's
crazy.
They did it. What are they gonna? What are they gonna do on Monday?
Carl says everything is good except there's this horrendous noise every time JFresh or Dork talks.
Is that a joke or is that serious?
Carl, I don't know.
It's not. He's not serious.
Okay,
that
good.
Bastard.
Fuck you, Carl. You're a goddamn shill.
Yeah.
Well, I switched it to the backup YouTube server, so everything should be good now.
Okay.
Yeah.
So
just hey, Carl. I had my wellness check, my yearly wellness check recently. T levels, perfect. How are yours doing?
Ooh, low blow.
You still injecting tea into your balls?
It's in between his toes now. He blew out the other veins.
So JFresh, you were saying something about the options market looking like shit.
Yeah, we can talk about it. There's not much to talk about. I mean, everything looks terrible. The level of bearishness pretty much getting to bottoms of some of what we've seen over the last 2 years since we've started taking all this data, which means, and that doesn't mean that like a bounce is imminent. A bounce can certainly happen. So if somehow they're able to push up and they can just initiate another squeeze and then off we go, and we just have to wait another 2 weeks for all that to resolve. Or we can just keep going. There's nothing to say it can't stop. I mean, in the past when we've gotten to these levels of bearishness, there's been plenty of times where the market just kept going for like 2 weeks after that, and we just kind of the bearishness just kind of bottomed out and just stayed there until something reversed. But from a volatility perspective, I could see a reversal. I mean, vol is still pinned, even though they're kind of on their backs, their heels. They've still got it pinned, and if they can turn it around, we can get some real puppies out of short squeezes. So that's why I kind of say we're either just gonna crash or go straight up. I don't know which one, but I doubt we're gonna stay flat. If we do, I'll be surprised.
Yeah, no, that's pretty much what I got out of what's going on. But I have some interesting charts to kind of like, so from the vol perspective, Girk, if you can open, I just posted a chart.
Okay.
And this is kind of
let me add one more thing just to conclude the options so we don't have to come back to it. In regards to volatility, I will say the total amount of open interest and like delta exposure on the chain does seem to be dropping, especially for like the individual names like the Mag 7, as well as just total number of puts on the chain. And it does sort of look like a lot of those puts, the drop in put OI interest would be the sold one, and I think that's consistent with our like huge swings in Vegas. So I do think that whoever's been shorting puts and shorting vol on the individual names is trying to exit a big position or has exited. And so that'll be interesting to see if other participants can come in and hold down vol with this, whoever this person is clearly getting out, or people. Anyway,
yeah,
that's all I have to say about that.
that's exciting stuff too, because it kind of points to there being less decelerant in the volatility market, right?
Yeah.
So that's really nice. So to kind of zoom out,
which time frame are you on here for this?
that's the 1 minute. It's the 1 minute, but you use like the 5 or something.
Okay.
It doesn't really.
All right.
I just wanted to point out, like, kind of like the behavior from open to close on Friday.
Yeah.
I found this extremely interesting, and it really, I think, points out what was kind of happening in the broader market. So on Friday, what we saw, and I guess, I think it was mostly Friday, right? Yeah. So on Friday, what we saw was an attempt to get vol out of
Positive territory.
backwardation.
Yeah.
And so what was happening though on Friday, and this was extremely interesting, was that they were never really able to get vol back in contango, right? That was to me a very, very interesting development, because normally there wouldn't be so much resistance, at the contango level.
Mm-hmm.
So what this tells us is that there was not just one trade happening on Friday.
Yeah.
There were 2 trades happening on Friday, and so this I'm trying to think of how to explain this. This means that bond buyers, or long bond, however you want to describe it, are now in a position where, and this is my opinion, because you see ketchup or you see relish going up throughout. What you're seeing is the convexity of the bond market increasing as vol was not going down, right? As vol sort of future pricing stayed flat. This ultimately indicates that for these people that are going long bond, i.e., long convexity, it is now advantageous for them to maintain backwardation on forward volatility pricing.
Yep.
And this tells us that while vol still may be suppressed, as evidenced on Friday, we are seeing that suppression of vol being resisted by an upside pressure.
Yep.
So what this tells us is that the ability to short vol to the magnitude that we have been able to throughout the year has drastically diminished because now one of the major participants, the bond market, stands in a beneficial point to maintain vol backwardation. So we are likely to see a higher vol environment for a somewhat extended period of time, I think. Maybe I could see this lasting for, between, 0 days if the market just explodes to 3 to 4 weeks, would be sort of my thoughts on how long this could last if it maintains through Monday and Tuesday. There's a chance that whoever is shorting vol is so well capitalized that they could actually crush this long vol, this long vol backwardation.
Mm-hmm.
But the signs to me point to the bond market starting to realize where it had fallen short prior to this period.
So I threw up the like the synth swap for the
Okay.
currency pair because I figure you're probably going to want to go into this effect as well because obviously this trade needs liquidity.
Yeah. So this is something I was watching on Friday too. And well, I mean, throughout the week, ever since USD JPY started getting really volatile.
Yeah.
So one thing we're noticing is either speculators or Bank of Japan or both, whoever, is starting to crush this spread a little bit, right? And what happens is anybody with exchange rate risk who is technically short yen, long dollar through their swap, whatever it may be. If you're net short yen and net long dollar, what just happened this week is really, really bad for your dollar collateral. You saw those spreads start to go down, and from a point where like anywhere in that point in between, you could see right there on Gerk's chart, if you went short yen, long dollar, at any point, on the second half of the 25th to the 26th right now, your dollar collateral just took a hit. And where we're trading at now in terms of that spread is really sort of at a risky spot for dollar collateral that has been opened in the last, I want to say, what is that? Where's my spread? I have my own spread somewhere. Here it is. So anyone who went short yen, long dollar from October 26th to now took a big hit in their dollar collateral.
Yeah.
And that is and so this is a I don't know if you have this one. It's that like light blue line I always post.
Oh, I might not.
I'll just share
this one.
I'll just share it. Wait, what do you got up? I'm waiting for my stream to buffer. This is terrible.
Yeah, it is.
Hold on. Okay. No. Oh,
Okay.
yeah. No, that's not that one.
Okay.
This is the actual yen spread here. I'll just post the chart. Because yeah, it's like the swap, but it's a little bit more. You're like taking two components of it rather than just the like the actual like swap pricing.
There it goes.
All right. Okay. Actually, yeah, I fixed my buffer thing too. I just clicked where it says 0, 0, 0, and now it works. So what's interesting is if you see where that dotted line is, that's Monday, right? That's the beginning of Monday. And what we see is that spread blow out in the first 2 days of the week, and then instantly collapses back down. And not only that, but reverts to this long-term trend we've been in for the past few months. Well, since the beginning of August, we've been in this sort of trend, and we're mean reverting back to it.
Yep.
So from where we're at, a majority of the short yen, long dollar trade that has been opened since near the beginning of August is probably at risk. All that dollar collateral that's been open throughout that time is starting to get at risk. And if you think about sort of the rush for the exit, right? That sort of, idea. What can happen to the spread is if all of that sort of starts to unwind at once, we could get this spread collapsing much, much faster.
Yeah.
And that's sort of what the whole idea behind watching this is that by seeing the spread collapse, we should, see knock-on effects in the broader market with
Well, we
respect to
should.
dollar.
So, I mean, this is one of the things that's kind of. So, I noticed on Twitter, like over the weekend, everyone's talking about like this mysterious force that's driving yields higher, right? Like US dollar or UST yields specifically higher. And this is like it, right? This is what's doing it. So there's no mystery, right? It's just this currency pair, right? And then Japan's YCC actions last week kind of nipped a little bit of that in the bud. For the first 2 days of this week, as it carried over, but now they're out of money for YCC again, and we see it exploding once more, right? And this is gonna push those credit spreads wider, which can rocket the dollar up.
Yeah. It's yeah. So and it's kind of like the idea of when the tide goes out, you can see who's been swimming naked. Um, this is like that, but with leverage, right? So when this currency pair collapses, we will find out very quickly where the leverage in the system is, and I think we already kind of have a good idea, but it'll be very interesting to see where we see the most leverage unwind in terms of what asset classes and even in equities too. How much leverage is packed into the equities market still?
Yeah.
Uh, and so this kind of lends credence to the idea that over concentrating the market in a small amount of stocks in order to maximize potential price movements, where that takes a lot of leverage to do.
Mm-hmm.
We'll see how much leverage it took to do that, because we'll see that small amount of stocks. We will see them have precipitous declines if they're over leveraged. So
What's
that's
more
kind of it's
important right now, SPX crash or Mag 7 crash?
that's the same thing.
I mean, the SPX, the S&P 493 is kind of already crashing.
Right? Yeah.
Yeah, everything's kind of crashing, just not Mag 7.
Yeah, well, I mean, even they're definitely getting pressured. Although, yeah, they're still basically holding most of their gains from this year and still holding their percentage. But it has been interesting. I love to see everybody confused on Twitter who's selling their bullshit. But it's been interesting to see, like, oh, hey, the Mag 7's earnings were stellar across the board for last week, and the market was still tanking. And they try to come up with narratives from the earnings to explain it, but I mean, 10 to 30% year over year, or year over year growth is pretty bullish, right? It's hard to say Google went down 10%. Because its year-over-year growth was like 15%, right?
Yeah.
20%. And I think it's just because of this trade that you just described, right? That's what's running everything right now, and nothing else. No other narrative can come close to the magnitude of that trade, which is kind of scary to see.
It bleeds into everything. Like it literally pervades the entire market. It is integral to how liquidity flows through the market. When you think about how you collateralize junk bonds by getting collateral swaps with treasuries, things like that. These same collateral swaps are used all over the place for all kinds of things, and it almost takes it going in like a full-on loop back to the person who opened the original swap in order for things to like really fall apart. And that's like the unwinding part. And so it's
I think it is slowly unwinding. I think people are trying to get out of it.
yeah, I agree.
Yeah, risk is too high, and it's not priced in.
So Girk, I have a great chart. Two above the light blue guy. I have the credit spread charts.
Oh, okay, yeah. Which one do you want me to start with?
You can start with the top one,
Okay.
and then so the top one is zoomed out, the bottom one is zoomed in.
All right.
So to start with the top one, just to kind of give a more broad overview of these spreads and where they're at compared to historical levels, we see that AAA, triple B is relatively elevated, but it's still not really reflective of the way I think risk should be priced in the market. We should be closer to 1.3% or about 20% higher than we are now on AAA, triple B spreads. AAA high yield is also elevated historically. You just, if you kind of don't really pay attention to how how high the peaks go, but in terms of like the averages, we're at a relatively elevated level.
Mm-hmm.
However, high yield spreads those are drastically underpriced from where they should be, considering all the bankruptcies we've been seeing.
Yeah.
So delinquencies in business loans are still low, and so that's why I think these credit spreads are being suppressed. However, I think that those are probably going to start ticking up over the next 6 months. And if they tick up at all in that period, we're going to see these spreads rise. But let's look at the zoomed in one now to give like a short term perspective on where things are headed with these credit spreads. Because this is, I think this short term chart sort of illustrates what we're talking about when we see people trying to exit quietly from these trades.
Mm-hmm.
What we see on the short term chart is we're seeing high yield spreads bounce, right?
Yeah.
We're not really seeing that too much from the AAA, triple B spreads, but we are seeing it in high yield. And it's now officially an uptrend, right? And it's a very strong uptrend. So the Friday hasn't printed yet for the spreads. I'm going to be very interested to see where they end up, but with such a big risk off day, I could see them both having risen.
Yeah.
Depending on how much triple B got sold, I'm willing to bet that that all those yields went up. It's just to see which ones went up more than others. And if we see high yield going up a lot, and we see triple B going up more than triple A, that tells us that because these recessions start from the bottom up, it tells us that a increase in an increase in risk as a proportion to quality of the loan is going to be increasing, right? So you'll see this sort of bottom up effect where high yield spreads move up fast. AAA, triple B is ticking up, but it's always slower to go because in order for triple B to have risk priced into it requires that all of the smaller companies must be much more risky, right? So it's like a bottom up sort of effect from that.
Mm-hmm.
And we're kind of starting to see it just a little bit. And I don't want to go all out and say, yeah, man, spreads are going to the moon, but they're definitely not looking as strong as they were like at the beginning of the year. So we're
and part of this is the unwillingness to price in higher for longer, right?
yeah, and it's not the thing is that we think that vol is the only thing suppressed with the carry trade. No, it's spreads, it's vol, it's price action, it's everything. Even
Equity
yield.
valuations.
Yeah.
Yeah.
Well, it's the thing is oil, it's nat gas, it's commodities, broader commodities. Like this is something that pervades everything. I mean, like this is not just one asset class that is being chugging along from this trade. It is every single asset class from bottom to top. Like we're talking MBS, CMBS, every ABS, slabs, and probably not, okay, maybe not student loans, but everything else, that you can attach a dollar value to, this thing is fueling any sort of leverage into those asset classes. So it's a very, very pervasive trade, and you'll see it reflected through spreads, you'll see it reflected through vol, you'll see it reflected through price action, and we saw all of that heading into Friday. So that was super duper interesting, and it does definitely point to what Jay Fresh said, where someone is trying to exit this carry trade quietly, and the people who are exiting are not small.
Nope.
You said it has an effect on everything. What about M2?
That's actually a very
So,
interesting point.
Yeah, it increases velocity.
Yeah, it won't change M2.
Velocity is still, yeah, that GDP print velocity went up. But the thing that really strikes me as odd is that M2 really hasn't gone down in like 6 months, 7 months.
M2 should
It's
never
been
go
flat.
Yeah, that's flat is bad still. M2 should only be increasing.
I understand the consequences of that from from the debt fuels growth, which fuels more propensity to handle more debt, and as long as you're growing, everything can continue on, much like a Ponzi scheme.
Yeah.
But I mean, we know that M2 has to come down because the Fed's tapering, right? And it started to come down, and now it's just been flat. And everyone's talking about all the, M2 is a measurement of credit, right? And credit's not going down. So credit is still being extended. And with the velocity continuing to increase, right?
The inflationary pressure.
Yeah, well, yeah. I mean, I hate to sound like one of those, crazy people that thinks the Fed's lying. I don't think that anybody's lying. I just think that's, I'm not an expert on how they gather all this data, and their expertise
I don't think that the
is
Fed's
notable. Their expertise is notable and exceptional, and I think they do a great job at what they're attempting to do. But I feel like there's got to be some amount of uncertainty in, how do you decide from the sets of data that they gather that it was an increase in productivity versus an increase in prices, right? I mean, it's just really difficult to untangle that, and I think that's why there's a lot of revisions as you go forward, and you have to look over, long periods of time. But I feel like they got this GDP print wrong, and I can't prove it, and I don't think they did it on purpose. I just think that the way their methodology is built, somehow they're not capturing the fact that there was more inflation than there was growth in productivity.
You know what kind of tells you that is the Case-Shiller home price index, right? The year-over-year rate of change bounced, and from where housing pricing is, right? Like that kind of tells you the whole story right there, because you're looking at the price of the most significant asset class in the lower rungs of the economy bouncing in price, right? When literally nobody wants to buy a house. That kind of tells you everything in terms of productivity and whether or not it's productivity versus just prices going up, right? So yeah, I completely agree that the data they're using and the way they're calculating it, into their how they're baking it all into one big number is tragically skewed from reality, where the most important things for most people in the entire economy, hundreds of millions of people, is the ability to place a roof over your head, the ability to make it to work, and the ability to eat food, right? Housing is still well above the trend, the long-term trend. So for it to bounce from where it is utterly insane.
Yeah, I looked at I always check the PCE numbers for housing, because I feel like that was the big narrative. As we started coming off the inflationary peak of 2021, 2022, the narrative was, well, housing is lagging. Housing's still going up like 6 to 7% annualized as of the latest print, right? So I think we're pretty close to calling that theory dead. Yeah. And so you have to ask yourself. I would love to pick the brain of somebody that works in the BEA about some of their methodologies and how they feel about the limitations of their data. Because, I mean, it just seems very difficult to tease out what percentage of the increase in, like, okay, we have an aggregate amount of how much people are paying for these different kinds of things. Well, how much of that is paying for the same amount of services or goods, and how much of that is getting more for what you pay for, right? I wouldn't want that job, but I think, I mean, this hot GDP print, it's all coming from velocity. So you either have to believe that the economy is heating up again, or you have to believe they got that number wrong and it's more inflation than it is productivity.
Yeah, it is an extremely difficult task they have, right? And that's, sort of where it's good to try to dig into what's happening, right? So, we hear things from, economists who point out aggregate numbers, and then swear to them as gospel, right? And there's some value to the aggregate numbers, but when you dig into the minutia, you can start to see the cracks in the logic formed just by looking at the aggregate number, and not only the aggregate number, but the rate of change of said numbers, right? That's the part that I think a lot of people sort of brush under the rug, is how these things are changing, because they believe that, the data at a rate of change level is volatile. And while I agree, it is still important to look at it. First derivative is very important in any sort of, stochastic system.
Yeah, I mean, the other thing about the GDP that was shocking was, which I also feel is a little inconsistent, or maybe it's not. Wages only grew 0.3%, but spending went up 0.7%. And I mean, the only way to really think about that is the only way to think about that is that the consumer is leveraging harder, right? Which obviously isn't necessarily bearish if the consumers starting from a point of well capitalization or high capitalization, but I don't know how true that is, and it's certainly scary if our economy is being floated by that. But also, I also would love to know how much of this is being driven by government spending, right? Because the deficits are definitely. I mean, the way I think about government spending is, at first it is an economic boost, and then it shows up on the back end as higher rates. Unless, the Fed prints more money, but the Fed's not printing money. So you get a boost in GDP, right? Because the Fed's juicing the economy, right? And that money starts floating around and, proliferates. But then they have to sell more bonds, and so the rates go up. And so, if anything, this high GDP print to me tells me that it's still not time to get into duration. Those yields are going to go higher as Yellen, was it Tuesday, is telling us what their quarterly refill sort of schedule is going to be going forward, which I think will probably shock some people.
I mean, so yeah, I agree. And if here's my biggest question is, what is going to happen in about 8 months when on RRP is empty? Like, somebody's got to come in and provide liquidity to the Treasuries market, right?
Here's the issue, right? Because you and all three of us, I mean, we were talking about, obviously this was closer to like the super stonk days when nobody understood what on RRP was, except big number go up means GME MOAS. But I mean, the whole sort of argument for on RRP was one to, help pin short duration prices or yields to the Fed's rate, right? But
Yeah.
also to provide a buffer of liquidity for when the economy starts to go poo-poo. But here we are, the economy is cruising along, and on-RRP is being drained to, number one, capture, all of the liquidity, all of the issuance in the bond market, but also just to try to chase more duration in general, because they're just trying to play the game and mix in some duration, right? Because you can't perfectly time the peak, so you don't want to just be in overnight, because then if rates drop overnight, you lose out on all those. If you had bought 6 months to 3 years duration, you're missing out on all that. So those are the dynamics that are at play right now, but the economy's still strong. So yeah, if the economy doesn't crash in the next few months, we're going to have much less of a buffer to handle that.
I mean, I think at this point, and this is, this goes back to like shit I was writing about after Jackson's hole, right? Where, it became really obvious that the Fed's kind of leaning on the Phillips curve, right? And that they're just going to drive rates until they get the recession that they need to cool the economy. And this completely counteracts that. Like, this GDP print throws that entire approach under the bus, right? So I feel like, despite the forecasts from CME, JPOW needs to act within the next 8 months harshly. Like, I mean, they really need to take a much stronger hawkish stance. And I'm not talking like, 5.75. I'm talking like 6.50 to 7% federal funds
But
rate.
do it.
I mean, but do you see, like, they need to drive unemployment down, and they need to cool the economy, because the economy, I mean, like, part of the problem is using the Phillips curve to address supply shock inflation anyway, right? When we didn't really have an over lending issue, which unfortunately is what federal rate increases are best at addressing inflation. As a producer of inflation, they tend to address over lending practices best. And they're not really particularly good at addressing supply shock inflation, or like wage spiral inflation, right? And it's almost getting to the point now where, like, if he doesn't act before that liquidity runs out and actually take steps to destroy wealth, which the bond market's kind of trying to do for him already, but obviously they're still limited by the effective federal funds rate, then that liquidity buffer is going to dry up. We're going to have nothing there to support the economy, and then all the wealth gets destroyed, right? Or, well, most of it.
Well, the ability to leverage wealth gets destroyed.
Yeah.
Which is effectively destruction of future wealth, right?
Yeah. How much base money exists? It's just a few trillion, right? And then M2 is like 20 trillion.
So I mean, I think this uptick in the bond market and this constant leveraging of like foreign yields in order to provide liquidity to these banks is working directly against the Fed. And he can't cut rates to collapse the spread and stop it, right? So the only thing he could really do is make rates so high that it cripples the economy.
Yeah, he's
in that quest, don't you just drive a depression?
The other thing he could do is be a cuck
and market
hold rates. Well, that would be that would be an alpha Chad move. No, I think he could also be a cuck and just hold rates where they are and hope that something else somewhere magically blows up for him. Kind of like what he's been hoping for the last year and a half, right?
But on RP's running out and Yellen can't stop issuing, right? So it's like the timer is there, right? Labor market doesn't show any signs of significant contraction. I mean, almost to the point where we're actually starting to see some productivity because so many more people are fucking employed, right? And then, you know, that's
Yeah.
gonna drive that wage price spiral even higher. And still no recession, and now, you know, it's looking even less like we're gonna actually get a recession because of it. I mean, he really needs to break something. I mean, this is a very similar situation to what Volcker found himself in, right? Except it's accelerated at 20 times the speed that it did back then.
No, I mean, it's been a lot of fun, just from an academic standpoint, watching this unfold and seeing how different behaviors of different parties clash, right? And I mean, it's pretty clear that the entire world is fighting the Fed and just saying, I'm not going to eat this inflation shit sandwich. And here we are. Someone has to eat the shit. No one's eaten it yet. I'm going to keep saying it until it happens. And I hope it's not me that has to eat the shit sandwich. We'll find out.
I mean, the Fed needs to force someone to eat it. They need to tie down the G-Sibs and ram the shit sandwich right into their throat. Because, I mean, it's
For
either
the banks to
them.
eat the
I
shit
mean the
sandwich, but
rates
it's going to
are
be us,
already
right?
the rates have already put a timer on all the corporations, right?
I mean, Powell and everyone's just licking their chops, seeing the wage growth of 0.3%, right? I mean, they want to see that. They want to see that number keep driving down. Just slowly let the wage earners eat that shit over time.
There's not enough time.
Yeah.
Yeah.
So another fun chart, Girk, to kind of talk about the leverage exiting the system is my sparkle dots.
Oh, okay.
Oh God.
Your favorite.
My favorite, the sparkle dots. It's so noisy, dude. Like, it's so noisy. So so sparkle dots, right? And this chart is actually the liquidity index for oil futures. And I found this chart really interesting because it's just super interesting. I don't know. So with everything we just
You
discussed, right?
motherfucker. Look at my sparkles. I find them interesting because they're pretty.
Exactly.
This is his hottest analysis yet. Let him run with it.
Yeah.
All right.
I switched over to commodities, guys. Like, give me a break. So it's interesting to see that heading in through October and into October, we see a big drop in the liquidity index for oil futures. At the same time that we do see the carry trades start to experience some volatility, right? So it sort of tells you that there is instability in the order book for not just which SPX's liquidity index is still down at a lower level. So it's not just for equities, but we're seeing the order book for commodities also drop. So, you know, that combined with the increased volatility of the carry trade tells us that that we are seeing some knock-on effects of dollar liquidity going down. So yeah, it's very interesting, and this is why, you know, the whole idea of, you know, the gambler's fallacy that we have to bounce after being down so much may just be that, because there isn't a firm order book that will move with the price of stuff. And without that, your ability to maintain your collateral and core positions is reduced. So this is it's a tricky point. And yeah, it's just this last week was very interesting to see, you know, sort of the bid fall out from under the market. You know, not like a crash, but like where there just wasn't enough of a bid to catch the market as it dropped until very, very important points, right? Like super important
Yeah.
points.
Well, the market's been trying to do this since March, so it's nice to finally see it start to make some progress.
This is what it
The
should have
market
happened in March,
yearns to
right?
find higher liquidity, and it must find it at lower prices.
Yeah, this is what should have happened in March, but didn't. So I mean, it was sort of because the bleeding was stanched in the liquidity of the Treasury market, but all it did was enable large institutions to be able to perpetuate the carry trade even further and make the situation even worse
Yeah.
through more leverage and dollar liquidity. So what we could have had in March, we've now had an accumulation period, right? And that accumulation period is really, really dangerous, because you have a bunch of currency pair risk or exchange rate risk, that's just been injected into the market. And if that starts to go underwater, even if we reach March levels, it's going to start getting extremely dangerous for these large institutions as they try to exit their currency pair trades without incurring losses, right? Which is what they want to make sure they can do. So we're not there yet, but we could get there pretty freaking quickly if things.
Yeah, I would love to see them forced to close that position. I mean, they're already getting pressured to close it faster than they want to, but I'd love to see that just
collapse.
Oh, man, I wanted 4100 so bad.
If 4100 was lost, we were going like to 4050. If it
I
had
mean,
been lost,
I can see that red candle happening in my mind, just tapping 4100 and then just blah.
the only way we're breaking 4100 is with a gap. That's the way I see it. We're gonna have to gap over that, kind of like how we gap over the MAs.
Yeah. Well, you mentioned we have to bounce because we're going down so far. And speaking of trends, you guys ready for the Santa rally?
No.
Oh, do you have the images, or do you want me to just pull them from your Twitter?
You can pull them from my Twitter, or not. I mean, I can just talk about them. They're just
Okay.
histograms and shit. It's pretty basic statistics. I didn't have to.
No, you don't.
I didn't have to dig too hard to show how ridiculous the Santa rally is. So okay,
It's like well known institutionally that the Santa rally is bullshit.
good, because I am so sick of seeing seasonality charts and all this other bullshit. It makes me angry, and so I figured, let's do some statistics. And Girk was nice enough to get me 90 years of weekly SPX
You're
data,
welcome.
so I could, yeah. So I had a fun little thing to work on this morning, and I plugged that bad boy in, and I wanted to find not only the mean, the average amount that the SPX goes up throughout a year, but the variance, which is what everybody else leaves off. And of course, exactly as I was anticipating, the variance is larger than the mean itself, right? So what that tells you is that over a 90-year period, you can expect to earn about 7.8% a year on your SPX investment. That does not mean that in any given year you can expect to earn 7.8%, right? And for a single given year, if you want 95% confidence of where you will end up, that range is negative 25% to plus 40% for any given year. And if you look at just the last portion of the year where everything looks like a Santa rally, if you look at the average returns throughout the year, yes, after October, going into November, there's a period of stall in the mean, and then right as you get into November, it just shoots up and captures the remaining 40% of the yearly gain in the last 2 months, right? That's the Santa rally. But if you look at the variance The returns in the last 2 months relative to the returns of the first 10 months, there's nothing really spectacular there, and there's not even really any correlation between how well the first 10 months do and how well the last 2 months do. So if anybody is bearish and is worried that seasonality flows are going to, be working against you, that's not necessarily true. Now, does that mean that you're not going to have bullish flows? No. I mean, certainly they could come in, and all the seasonality people will retweet themselves and claim, how correct they were, that they found this, this secret, right? But don't be surprised if we just keep going down either, right? Because the seasonality argument statistically is bullshit. It's literally noise. It's noise. So yeah, and it makes me mad to hear Kim Carson talk about a Santa rally, because makes me wonder what's really going on in his head.
Yeah, it's really,
he should know better, right?
well, yeah, from the FinTwit perspective, it's copium, right? Seasonality has always been copium, but when we talk about what people say to mainstream media outlets, I mean, considering sort of the gravity of the situation they're in whenever they talk to the mainstream media outlets, right? There has to be a lot of curation done to that narrative, and I'm sure that there are people in these firms that do believe in this seasonality, because they looked at the charts that the FinTwits looked at and they didn't dig further.
The charts that Goldman and B of A are putting out, right? They're putting out bar plots of, the average returns by month, right? November's a bullish month. I think it's more pervasive maybe than, I don't know, Girk has more experience with those folks internally, but this idea seems to be pretty pervasive amongst the large institutions as well. And it doesn't shock me at all that none of them know anything about even basic statistics.
I think that's something that you run into a lot with these like Twitter experts, is you're running into like a lot who are like, oh, I worked institutionally, I was like sell side for 20 years, that kind of shit.
Yeah.
It's like these guys are just traders, right? Like they're desk traders at best. They probably didn't even run a desk. They just worked under someone else. Like these are not
some sell-side guy in exotic derivatives last night called me casual, and it hurt my feelings.
Wow, what a bitch. Sounds like we should burn him on a pyre. Is he selling products to people?
Oh, he is.
Of course,
that's the one I sent you last night. Yeah, $100 a month for like a newsletter or something.
Jesus, every time I see one of these, I realize I just don't charge enough money. Like it just, every time it's just like, wow, people pay that, and then I'm like, why am I? But then I don't.
Yeah, because you're a cuck.
Yeah, getting cucked by all the other shills. I'm not shilling hard enough, and it's like it bothers me because I want to win at everything, right? It shouldn't bother me, but it does, because I'm like, why are they getting more money for worse
You're like,
data?
I should win this, but you're also like, do I want to win this? Is this like a prize worth winning?
Yeah. But I mean, like Kim Carson's like a CTA, right? He was like a former CTA, and now he has like a lower level vol alpha fund, which he's advertised the shit out of on CNBC over the last, and like any podcast that would pick him up over the last like 6 months, right, to get some capital flowing in. And like that's what you do when you start a fund. You gotta go out there and beat the streets so you can find some investors, and then once you have some investors, your narrative changes, right? Instead of telling the truth, you kind of need to tell what your investors want to hear. And it's one of the reasons like institutional finance really isn't incentivized to be truthful with retail, right? Because They don't want to scare.
Yeah, why would you?
Yeah, you don't want to scare your entire investor class into, pulling all of their money out of your fund right when you're over leveraged the most. Because, I mean, you guys have been doing this long enough to like look broadly upon the populace and be like, none of these people have any fucking clue what's going on, right? And so the last thing in the world you're gonna do,
3 years ago.
yeah, but like the last thing you're gonna do is tell them what's going on.
Oh yeah, I mean, and even it's like, could you, right? I mean, I'm not trying to make claims about how smart I think I am or how stupid I think other people are, but there comes a point in time where, like, I mean, there's people, everybody's met somebody where you're like, I could talk to them about this, but I just don't think that there's anything I could say to get them to actually understand it, because there's just such a large gap in like base fundamental knowledge that's required to grasp some of the higher level concepts. It's like, how do you tell some 75-year-old librarian in Nebraska how derivatives work, right? I mean, they're just not going to get it.
They don't, and the thing is, they don't really want to know. Like, most people don't need to know, don't want to know how the sausage is made. They would rather just kind of live in ignorance to the financial world, right? Which is tragic, but it's the reality we live in. Most people, when it's kind of like politics, right? If it gets brought up, people's eyes glaze over, they roll their eyes, they sigh, it's just the way people view the financial system is with absolute apathy, right? That's the way that people choose to view it, especially after 2008. Most people just don't want to think about it.
I remember a long time ago there was like a survey of like how many people actually knew the market crashed in 08 and like what was even kind of happening, right? And the survey was done in like 2011. And most people didn't, like, the vast majority of Americans didn't even know we were in a recession because they're too poor to be affected by one, right? And then, like, of the people that knew we were in a recession, only like half of those knew that the market had crashed. And so it just like the more detail you get, the fewer and fewer people are going to have any knowledge of it, right?
Which is so crazy to me because Wall Street has successfully woven the success of that market into everybody's livelihood.
Yeah, it affects every single aspect of everybody's daily life, and most people don't understand it at all. And for some people, to a significant degree, it affects their wealth, their ability to preserve wealth, their salary, right? I mean, everything, and most people, don't understand or care about it, which is unfortunate. But I mean, I think we're doing the right thing in providing what education people are willing to pick up, right? Because it can only benefit you to know more.
Yeah.
Yeah.
And really, I mean, ultimately, like, when it all comes down to it, I mean, we're just three people, right? Like, we are
doing the best we can with the data we have. We're trying to get more data every day, but it's
tough. So, like, yeah, we're just looking at things that everybody else can see, and we're just trying to come up with an honest perspective that more so fits the doesn't really fit anything, but it sort of lends more credence to what everyday people see, right? Like, it's very obvious when you walk down the street what's going on, but when the headline data doesn't reflect that, or, like, equity prices, things like that, uh, you know, something's up. A lot of people, when they do their analysis, they look at these snapshots, these headline numbers, and they agree with those more than reality, right? And I think we just have the gumption, along with a lot of other people. Like, we're not the only ones who can do this, right? Or who do this. Ha! I said do.
Do. Got it. Gotcha.
Well done.
But you know, I think what we bring to the table is just we're not rereading news headlines that are bearish articles from people who, you know, have puts. We're looking at the data directly. We're finding different ways to analyze it, and but in reality, you know, I would encourage all of you to go and look at data for yourself and come to conclusions for yourself. You may find it contradicts us, and that's totally cool. And we're willing to discuss any contradictory points of view, and we do. But you know, I think
Yeah,
that's
I mean, I think that's a really important point. I don't think that we, even though we've dug around a lot and we think we're sniffing out a lot of what's going on, I don't think any of us still feel extremely confident that we have the whole picture, right? So I
No,
would say
I
we're
mean,
still,
I can think directly of like 5 things we could do to paint like a much broader picture over the next like 6 months, right? Or a more detailed picture. So yeah, I don't think honestly I don't think the quest for that is ever done, right?
yeah, it's always changing.
And with the data we have, because I mean we are still retail investors, right? I think with the data we have, we've just attempted the art of mastering like the negative space, right? And that we try to use the data that's presented us to us to discover the data that's hidden from us.
Think of it as, I mean, I think of all of this as it's just puzzle solving. I like to solve puzzles,
Yeah.
both figuratively and literally. But this is, I mean, it's basically, you know, a 1 million piece puzzle, and we have 10,000 pieces, or let's say 100,000 pieces. Can we figure out what the rest of the pieces look like from those pieces?
Yeah.
And
yeah.
but yeah, I mean, the important thing is that, you know, you've got to build a framework to evaluate things so that you can look at things in the media and things that are said by certain individuals and test it, right? Does this make sense? Is this consistent with the body of information that I already have? Um, or if it's new information, you know, is that new information consistent with my previous model? If not, uh, is that new data uh, flawed in some way, or is my model flawed in some way? And then you have to go through and try to adjust your what your expectations are based on that. It's a huge process, and it's always changing, and it's never done because
Super fun.
people's positions are changing. So yeah, it's fun to see how much you can game this out. I mean, it was super frustrating, with like the huge pump that I would say, I think it's fair to say we all pretty dramatically underestimated going into the summer of this year. But I don't think any of us were really shocked that it started going back the other way. I mean, we kind of knew there was enough going on there that it was much more likely that we were going back down instead of, soaring to new all-time highs.
Ironically, if we'd just gone super, super long short any time during that period, we'd be up now.
Yeah.
Yeah.
Especially at the top. And you know, we did. I mean, I don't know about you guys, but I stayed
Yeah.
bearish. I bought calls, but I was bearish as fuck, you know. Like I wasn't gonna ignore the thing going on right in front of me, but at the same time, like I knew it wasn't gonna last.
Yeah. It was quite
And and
quite the
and
run though.
and to be fair, the direction the market took after the bank failures was extremely unexpected, right? Like you wouldn't assume that large banks would take on that much equity risk that fast, right? And
Yeah.
now
It was,
you
it
know
was wild.
now they're gonna have to face the music, right? Because now their Vega risk is underwater and look like volatility is draining out of equities, and there's only one place for that vol to go, and it's going there, and it's going there quickly. And you know the bond market's supporting that move, and they're probably going to be a lot more fucked moving forward than they already are now.
Yeah. Well, you think Israel boots on the ground in Gaza this weekend is gonna get some bullish momentum going?
I don't really know if that's bullish. I mean, I think that probably is gonna increase risk premium on oil, right? Which is gonna drive oil vol, which is gonna drive dollar expansion, and then feed back into yields moving, like spreads
Yeah.
widening, right?
What
Then we
about
get
what about
even
the
more
what
vol
about the
demand, like broader equity vol demand.
what about the U.S. hitting Iranian targets in Lebanon? You think that's going to be
Yeah, that's
good for markets?
that's what's gonna push the fucking oil risk premium, right? Like,
So
because now
what I'm
we're
hearing is
directly
Paul.
interacting. Now we're directly interacting with BRICS in a conflict.
Yeah, that's awesome. All we need now
That's
is for Biden to just like die in his sleep right in the middle of all this.
Jesus Christ.
It's funny because everybody listening to this right now just thought, "Oh my God, what if that does happen?" Nobody's like, "Oh, that's crazy."
It's a real risk with how freaking old he is.
Well, you know what? You know it's going to be Biden versus Trump for the next election, and Trump's just as old as him. But honestly, Trump's the genius, right? He's been putting on clown makeup his entire life to prepare for this moment, to mask his age. He just looks like the same clown he's always looked like. It's brilliant.
I hope a third party candidate wins if that ends up being the election.
I mean, Trump can't walk down a ramp, but everybody thinks he's the most virile man on the planet.
Dude, neither of them can walk down a fucking ramp. All right,
I know.
Yeah,
my point is they're both old.
Yeah.
Yeah.
It's not just like Biden's like 4 years older than Trump.
Yeah.
Like they could be siblings.
Whatever. Anyway.
Yeah.
Like, what if I said something? What if I said something crazy like,
let's just
I'm
get.
not even
Why can't we
sure-
just get McConnell for 4 years as president? He can just. he'll just stand at a presser podium the whole time without saying anything.
I mean, it'd be an improvement probably.
Yeah,
but,
that'd be a better president. I'd take that.
What if I said something crazy like,
yeah, YouTube
I'm
servers
not sure.
are fucked.
I'm not sure that Trump can wipe his own butt. And it sounds insane, but you could look at them and be like, he might be right. Does he have the arm dexterity to perform that function still?
I could ask the same question with it's bad.
I mean, I saw photos of Biden jogging again the other day. So I think Biden can wipe his ass. Maybe.
Maybe.
I don't know if his torso. I don't know if his torso.
For all you know, Biden
twists.
could have a colostomy bag.
Oh Jesus!
That's true.
Winning.
Yeah, he's being
You
efficient.
wouldn't even know.
Yeah, he's just shitting.
I mean,
while
unless you're
he's
close
talking.
unless you're close enough to smell it.
Yeah.
Oh God!
All right, that's a dark hole. I never want to see the Discord go down again.
Emphasis on hole.
Yeah. We've been down the colostomy bag road before, and I don't think I could deal with a second round of it.
Oh my God.
Oh God. Well, now that we've gone completely off topic, you guys want to talk about my pool?
What I do want to address one thing is so Cam has a vol shop out of Chicago, and vol shops in low volatility regimes are incentivized to push themselves. So you see guys like Cam and who's that other dude who's been making the rounds on Sidal. They've been making the rounds on podcasts and shit, and they're all incentivized because they're selling their customers vol alpha, which is like a defensive, right? Like you're afraid the market's gonna go big boom, and like people need and so they generally don't have a lot of customers, right? Because vol's like 90% of the time in the market, vol's just being shorted, right? And so the alpha there is kind of shitty, but when you're in a really low volatility regime and that looks like it might break, that's a great time to pick up a bunch of long-term investors for your fund, and you really see them like all kind of out pounding the pavement over the last 6 months because they see many of the same vol opportunities that we discuss with you guys, kind of right around the corner. And because vol control is so overexpressed in the market right now, then when we move into a high volatility regime, vol alpha is very successful. And so, yeah, they're trying to pick up as many customers as they can, please them, and then you get another round of customers, right? And maybe that floats your fund through the periods of low volatility when those funds are moderately less successful. But yeah, there's only so much you can gain from what they're telling the public, right?
Yeah,
Because
I mean,
they are
they don't
always
ever
going to be
reveal.
motivated by their own. Yeah.
Yeah, they don't ever reveal trade secrets. They make statements about what they see, but they don't explain sort of what data they're using to come to that conclusion.
Bloomberg, just Bloomberg. Bloomberg's got all kinds of vol tools that you can make assumptions off of.
Oh God.
Yeah. Wait till you get to expose the real shills.
Wait, is Bloomberg just like institutionalized dork charts?
Kind of, yeah.
Oh God.
Like you can basically take
glitter plots?
you can basically take any like assets you want, combine them, and make a chart for whatever you want to make a chart for.
Do they have glitter plots?
No, that's unique to Doric. But they do have scatter plots.
I can
It's time to make a Dorkberg terminal.
Oh no, you don't want that.
Is that racist to add Berg on that?
Our cycle's gonna come back with a vengeance and other names once VIX is normalized. Ooh, I've been waiting for this question. Yes. So this is the coolest part about the dispersion trade, right? Is that as funds move short vol equities and out of short vol indexes, we start to get OPEXs again. God knows on what stocks, but we'll get them, right? Because short vol will close, whatever time frame that they can continually short vol until they have to cover their exposure, right? And so that'll lead to OPEXs again. It might not be GME, right? But it could be something new.
Yeah, like energy.
Yeah, it could be energy. It could be utilities. I noticed utilities are quite short currently. HE comes to mind as one, but that's a lot of, there's a lot of other ones. There's a lot of utilities and energy and broad commodities that are currently being shorted very, very heavily. And so much like we had like all of the stocks that ran with COVID, like all the like Teladoc and fucking Zoom and all of that shit, right? That all had like a lot of like high vol action in 2022, right? They had like crazy earnings and OPEXs, docu. Like, and then GME, had them the year before that because that all got shorted into the crash, right? And then everything getting shorted this year will probably have like high volatility next year, and I think that's always just going to be a thing that's there, right? As long as it's advantageous and there's alpha to be gained on the edge, people are going to be putting money into it. Kenny's going to be there.
Thank you, Kenny. On that note, Ken Griffin actually, he did an interview recently and he sounded kind of bearish.
He's been bearish the whole time, actually. He's been getting fucked all year.
He was like actually kind of like, saying like, yeah, I'm not exactly sure. He's very, very, very neutral.
Yeah.
But I could hear the bearishness in him. It was beautiful.
Yeah, the fear. Even Kenny can be afraid.
A little tear came out of my eye, and I put my hand on the screen, and I was
How do you guys feel about Jamie Dimon, quote unquote, diversifying his assets by selling $140 million worth of JPM shares?
I mean, it makes sense. The bank's probably not going to gain any valuation for the next 5 years. Any significant valuation from where it's at. It's probably only going to go through more bullshit, right, before they recover. Higher for longer, and then so higher for longer is going to weigh on all the bank valuations for quite some time. And I think he's getting old enough too that there might be time to consider moving on. I don't know. I mean, I don't know how much. I think the bigger thing is going to be a shock to the people that believe in him so strongly. He's kind of like Peter Schiff or Dave Ramsey for boomers, right? Like a lot of boomers treat the word of Jamie Dimon like the word of God. And he's usually, I'll give him this, he's usually pretty honest with his takes, even if they're vague, and he's been calling for higher rates this whole time.
Yeah, he was saying what, 6-7% on the long end.
Yeah. He thinks the Fed needs to move much higher.
Yeah, if the 30-year hits 7%, it's all over.
Oh yeah.
Yeah, like it's so. I'm sure what's been happening in the background has been a lot of, once again, to bring a full circle to the fucking carry trade is, banks have been trying really hard to get their yield and get loan volume up, right, for the past year now. And they've been.
Did you? I want to point this out real quick. I'll let you finish your thing, but I wanted to squeeze this in for a while now while we're talking about banks. And now you're talking about yields. Bank earnings were all pretty good this quarter. Did you notice one of the key features of all of them? Increased leverage. Increased leverage on their deposits.
Okay.
I think Wells Fargo was the only one that did, or either had the lowest or actually didn't increase their leverage ratio. Yeah, this is another one of those head scratchers. M2 flat. All the banks are increasing their leverage ratios, but we're talking about credit crunches. It's anyway. Go ahead.
It kind of makes sense though, right? Because that's the only way to really grow their investing activity profits, right? Is through their leverage ratios.
They've got to seek yields. They can't stop lending.
Yeah. So what's been happening, right, is, and this is going to sound kind of stupid, but we've been getting really, really good rates throughout this rising rate environment. We've been getting really good mortgage rates. It may not seem like it, but the reality is that the spread between a mortgage rate and the 30-year is
it's 3%, right?
It's stupid. It's almost nothing, right? It's there, but you're not getting real yield of that spread, right? If you are, it's pitiful. Yeah. And so what's been happening is, as this carry trade has been able to survive, is banks have been like offering handies behind the Wendy's to get a fucking mortgage.
Yeah, you could, if you want to own a house and you don't care about anything but just owning a house, being a property owner, with a
at least for a short while.
You can. It doesn't matter what you do right now, how little money you have down, you will get a mortgage.
Yeah, like, and that's and so, but the thing is I don't think it's been satisfactory, and I think that's why Jimmy Dizzle has been thinking about doing this for a while, and I think he finally just pulled the trigger on it. Like, it seems like the appreciation in that equity is probably gone. As soon as the investment activities stop pumping money into their assets, you really stagnate on your valuation, especially without the loan volume there to hold it up, right? So
he's gonna be buying 30 years with it.
He might, but with the carry trade dropping, or the spread between yen and dollar collapsing, will definitely bring much higher yields on the spread between the 30 and the mortgage rate. Like, it's gonna be eye-popping what ends up happening when that happens, especially if rates don't get cut in conjunction.
That's all moving in a
yeah, we could see interest rates move up 10-12%, but that's also, remember that when we see those rates, if we do, which we probably will, or we see above 10% mortgage rates, we're going to see housing prices crash.
Totally.
Yeah.
I mean, it's slowly starting, right?
Yeah, it's getting there. People are
slowly,
freaking
although
out. We're at the stage where people are freaking out because they didn't sell earlier, right? We're seeing people with like low interest rate loans who have a high amount of equity going, "Oh fuck, I need to sell my house right now for 300% above market value before it's, at market value."
It's kind of like if you imagine like your average home, buyer seller is Indiana Jones with a torch in his hand walking through a dark cave, and he finally finds the wall and he slowly sweeps his torch across the wall and he's reading what the writing says.
I like to watch like home flipper Facebook groups to get a pulse on how people feel, and they're just freaking out.
Yeah,
they're like, don't sell your house for cheaper. We need to hold our market up. This is a nice area. Like all kinds of insane shit. And other sellers are undercutting them because they want to get out faster. And you keep getting people in those localized markets. You keep getting people undercutting the average home price, and all of a sudden that average home price starts to go down and down and down and faster. Well, not only faster.
But not only that, but your cap rate right now is your real yield on cap rate is literally zero, if not negative.
Yeah.
So you can't leverage.
But on the other hand, big builders their margins have never been higher.
Yeah. Because they get a sell right now at a 300% above market value, but that'll change, right?
Yeah.
Well, the problem is that those home builders are still they're still exposed to interest rates.
I feel like we're kind of like at the peak, but we're not quite like clearly over the peak. We're somewhere along the peak.
We're starting to get a lot of FOMO on the sell side, but we won't see a crash until unemployment spikes. It's 100%. It's when the people that have 3% loans can't pay those 3% loans. That's when it gets bad.
Yeah, you're talking about 15% of all mortgage holders.
Yeah,
like huge. That's a
but
huge.
That's getting squeezed too, right? Because their mortgage is 3%, but the taxes and the insurance, those are going up. I mean, mine have gone up quite substantially, and I mean, we all know how people, they try to buy as much house as they possibly can, not just as much house as they need. So, I mean, even just those bumps are probably putting people under pressure, even though they're still employed.
It all depends on where they got those rates. I mean, the thing is if your property taxes go up, 20%, it's not like your rent going up 50%, or, your mortgage payment going up, 75%. It's a completely different paradigm. Like they're probably okay because their wages have grown since.
Yeah, and then the voters that remain will fight back against it, right? And they'll put things in place to lower property taxes, and that'll ease off like over 12 to 16 years, right?
Yeah, it's really like the thing is like when I say 15% of people have a 3% mortgage, like if you look at the distribution, that's a huge fucking peak. Like
it is.
And
but
so if
the current peak above 7% is quite high too. and also one of those peaks is still growing and the other one not so much.
So the thing is though, is like if you want to get all Michael Burry on this shit, you can look at these distributions, and then what you can do is you can apply them to unemployment, right? And so you could say if unemployment goes up, 30%, right? What's that going to do to these interest rate holders, right? So this percent of 3%, mortgage holders is, let's just say unemployment goes from 5%, or what's it at now? 4% to
3.8.
Let's just say it goes. It's what?
3.8.
Okay, so let's just say unemployment. We'll just start at 4 because it's easier for the math. So let's just say it goes from 4 to 7%. That means that 3% of people lost their jobs, right?
Yeah.
So you could take that 3% and apply it to the distribution, right? Yeah. And you're really you're hand waving a lot because real estate is highly localized. But you can come to some bulk assumptions about how interest rates, like the aggregate, average interest rate is going to move in response, right? And not only that, but you can get a look at, what percentage of people have those 7% interest rates. That percent of people multiplied by that percentage unemployment increase is going to tell you the immediate sort of volume that you could expect roughly of homes being put on the market, right, within the next 90 days.
Yeah.
So you can go all kinds of Burry with this shit and figure out sort of, what kind of unemployment level should you expect to see this sort of a correction in housing prices. The correlation is probably really shitty, but you can come to some okay assessments on that. I don't want to go through
Could I
the
just
effort
buy
to do
leap puts on REITs and not think about it so much?
that. You could, but I mean, I hope you buy theta.
Yeah, of course.
You could do like a REIT bear debit spread
Mm,
on a
I like
theta,
it.
and
Yeah.
yeah, you can make your money that way and not be so exposed to the theta. But it's yeah, there's stuff you can do to sort of assess the reaction function of the housing market to increases in unemployment, and that's sort of how Burry did his thing,
Yeah.
right? He looked at the tranches directly, looked at the statistics of the tranches, and then extrapolated forward. If this many people lose their job, on average, these tranches are going to have this much of a default rate up to this quality of a loan, right? And
Yeah.
he, that was the impressive part of what Burry did. It wasn't that he just looked at the tranches and saw that they were shit. He saw that and he was like, wow, these are shit. And then he did a bunch of statistics on it to figure out where his shit would print.
He wasn't even the
And
first guy to figure it out. There was a economics professor from India that figured it out like 2 years earlier and was, crying wolf, and everyone was just ignoring him also.
yeah, but it's quantifiable
Yeah, it
to
is.
some measure, even for the uninformed investors. So I encourage, if you're a numbers person and you want to play around with that, look at those percentages and distributions and apply these sort of bulk changes in unemployment to, and make some assumptions about if this many people get unemployed, this percentage of them are going to have to, sell their home or foreclose, and those kinds of things. Which percentages are going to be more greatly affected in the short term versus the long term, and you'll come up with some very interesting, like you could say, okay, unemployment checks pay you this much, right? And then you could say, all right, so those unemployment checks are going to last this long. And what interest rate and home price do you think that, will have an effect to where those low interest rate buyers are going to get squeezed, right, on an unemployment check, and start to suss out the long-term effects on the housing market if unemployment doesn't come back down. You could really game this out super hard, and there's a lot of institutions that are already doing this.
Yeah. Well,
So fun stuff.
it is. Bipolar Bear thinks we need a bull to balance out all the bias. I don't think we're very biased. I mean, we're just presenting the facts. You just don't like them because you're a fire investor, and the idea of a lost decade or lost couple of decades is the scariest thing in the world to you.
Don't worry, I timed him out. His username was
Oh,
in
okay.
violation of
Yeah,
my
it
moral
is.
code.
A Bip Solar Bear. Yeah.
Yeah, yeah. The
Um,
outlook looks really, really weird. It really does. Like unemployment being this low is just so strange right now. But
I mean, I
it's
don't
too
think
much
it's
money.
something the Fed's going to tolerate, personally.
I
No,
mean, here's the if you want to be bullish, if you want to be bullish on stocks, there are scenarios where stocks will do very well. But unfortunately,
Hyperinflation. You fucking prick.
um, as everything that what's his face, the Peruvian bull predicted comes true, stocks should perform well. And if you look at the Mag 7, that their revenues are fucking awesome. I mean, go nuts. I think their multipliers need to come down, but maybe they just never do. I don't know.
Yeah, I mean, another thing you can do too is you can do stock picking. I mean, like really, this is a great time for stock pickers who like, you know, stocks that aren't, you know, in the mainstream. Like you can pop open on TradingView that heat map and just look at all the super negative year-to-date stocks and, you know, go nuts researching them and finding ones that actually have good fundamental value. You can make a ton of money on those, even though they may drop with a further market correction. They'll still outperform, you know, huge when the market recorrects to the upside when we resolve whatever mess we're in.
I mean, I
Yeah,
think
it's
I
not it's
mentioned
not a
this before.
bad time to go shopping, but it's not the best time to go shopping.
You're
Yeah,
going to be doing
I mean, I
smaller
think I
caps.
mentioned this before in one of my like bear capitulation rants that I have periodically. I get frustrated with how
Yep.
long this shit's taking.
Just be honest and tell people when you sell bear call spreads and they go in the money.
Yeah, on days where I try to sell a bear call spread and then it goes in the money, and then the next day it would have been super profitable when I don't sell on, and yeah. Anyway, I mean the Mag 7, they're basically monopolies at this point, and monopolies, you know, even if we just have like a stagflationary sort of like little recession, they're going to do really well because they have perfect pricing power, so they can pass on every single, you know, inflationary impulse that they receive to the customer, and they'll just have to eat it, or, you know. So yeah, I mean, if you think that we're not going to have a big recession and we're just going to kind of get some poo-poo, you know, stagflation, meme 7's great. Go for it. Yeah. And then otherwise, yeah, I mean,
Yeah, but how long until like margin margin collapsing, like, or yeah, margins collapsing, can they sustain share buybacks before it just becomes all of their revenue goes straight to share buybacks?
well,
Yeah.
share buybacks, I actually didn't even know this until recently, but the Inflation Reduction Act, or whatever it's called, there's a 1% tax on share buybacks.
Mm-hmm.
I thought that was interesting. It's probably not enough to do anything, but it's interesting. Provide a little bit of friction there.
Yeah.
I don't know.
Not a lot, but a little, yeah.
I mean, if people are just trying to maintain their wealth and they want stability, you know, flight to quality, you know, and Bitcoin's already going to be $1 million a coin. It's too expensive, and so they'll go to the meme 7.
Gold closed the week above 2,000. Do you think Peter Schiff's having a party this weekend?
Peter Schiff is probably balls deep in another human being right now.
Who's balls deep in himself?
True.
Yeah.
All right, let's wrap this up, because
Yeah.
I have a bunch of shit to do today. Do we want to do projections this week? I know we'd had a conversation that we want to warn people that when we do these, we're doing them with no data whatsoever. They're just like an arbitrary projection of where we think price is going to go based on the data. And yes, I do understand that 33% of the time we're really, really accurate each week, but that's not always going to be the case. These projections are more to give an idea of like where positioning currently is and how we see that playing out than they are a prediction of where the price on the S&P is going to go.
Yep. That's exactly what this is. We just think about everything we just talked about, you know, from options to all this shit, and then we just go, it could do this. You know?
So
Yeah, I mean,
do we want to keep doing that? Because we know that there's people like Farmville who are like, fuck. Girk
Yeah.
projected 4,100 end of week. I'm buying 4,150 puts, and sure, that would have been great this week, but I had to. The opportunity was open, but that's not going to be true all the time, right? Like projecting
Yeah.
like more beyond like our day
hold
by
on.
day.
Let me say this. While that would have been great this week, if you had followed Girk's projection to the letter and opened up 2 DTEs to capture that move on Monday, you would have been absolutely screwed.
Wait, did you do it at market open though? Because if you did it at market open with trail stops.
No. Buy to hold into expiry. That's what
Ugh.
everybody in your Discord is doing. Nobody is selling anything.
Nobody sells options, I know. Well, hold on. You would have gotten Wednesday? Yeah, you still would have won.
Yeah, we could keep doing them. I mean, like the primary reason we do them is
we don't have to draw them. I mean, we could be vague. Trends.
We could just pick up, down, or flat.
No, let's just keep
Yeah,
doing
but
them. I like the bragging rights.
All right.
Yeah, that's the fun part. Fuck all the people, right? Let's just do it for us.
Well, if you trade on this, you're an idiot. How about we say that as a disclaimer?
If you think this is in any way an accurate assessment of what the market's going to do over an entire week,
you're stupid.
Good luck. Yeah.
So who wants to kick things off?
I mean, JFresh got to start last week, so you can start this week. Because he doesn't want you copying him again.
Copy me again.
Yeah.
Okay. Let's see. So
it's funny because I already know what I'm going to do, and I hope it's exactly what he picks.
Oh man. Well, okay. I'm just gonna say what I want. Okay. So on Monday, we are gonna gap down to 40.70.
Ooh.
Okay. Retest 4,100 by Tuesday, by midday Tuesday.
So end of day closing Monday, 40.70?
Yeah, we could just say that. I was just going to draw a line from like 40.70 to 4,100 by midday Tuesday, like in the middle of the day on Tuesday.
Okay.
And then we are going to gap down again to 40.85. You can't draw gap downs with your continuous line, but yeah. So anyways, we're gonna open at 40.85. We could just draw a line down to like 40.50 by the end of Wednesday.
Hold on. Let me delete this because it's all fucked up and I'm too zoomed out. All right. So we're gonna go from our current price down to 40.70 by end of day Monday. Then...
No, we're gonna gap down. We're gonna gap down to 40.70 at the beginning of the day, and then we're gonna reach 4,100 by midday Wednesday.
Okay.
I'm sorry. This is getting too complicated, but this is what I think. This is what I think is gonna happen.
All right. So we stay at 40.70 into Tuesday.
Yeah, we get down to 40.70 by end of Tuesday, and then probably so start at 40.70, reach 4,100, back to 40.70 by the end of Wednesday, and then from there we're going to go down to 4,000.
Ooh.
What do you think of that?
Good.
I don't hate it. All right.
That's my prediction.
That's dork.
My turn?
Yep.
All right. We're going to open on Monday 41.40. We're going to tap 41.01. And then we're going to rocket into Tuesday to 40.70. And then I also agree midday. Well, sometime that day, when Janet Yellen slaps her big hog on the table with next quarter's
Wait, hold on.
issuance
So
schedule.
open 41.40, 4100 by end of day, then 40.70.
I'm gonna say not 41.70, so not end of day, but like sometime during the day we're gonna like maybe like by midday we'll hit 41.01.
Okay.
And then we're just gonna rocket to like 41.70 through
Wednesday morning.
through like Tuesday, and then sometime on Tuesday I believe Yellen is issuing the bond sales for next quarter.
So we'll do 1 o'clock.
Yeah, sometime around there. I don't know when I don't know if it's on a schedule. And then we're going to go back down to 4100 by Thursday, and then Apple earnings are gonna fucking tank us off the planet, and we're gonna go to 40.25 in the week.
Oh.
All right. So like that.
I'm not watching, but I trust you.
Okay.
Probably close enough.
Yeah. All right. I'm gonna say yes. We open higher tomorrow. I don't know 41.40, but I think above. I want to say like 41.25. I think we could slip 4100 in the. Actually, you know what? I'm going to say we could test 4160. I think we'll stay flat into the Fed decision. Flat, slightly up into the Fed decision. Then fall back into Wednesday. Then, yeah, I agree. Apple earnings, but I think. Hmm.
Ooh.
There.
I can't see it. What is it? Is it under 4?
Yeah.
Oh God, I'm gonna need like 10 minutes.
Oh man.
We do need a bull. We need somebody on here like
all of our
buying every
projections are
dip.
so fucking bearish.
We need
Here,
someone on here being
plot.
like,
I'll plot the bull. People get excited about JPOW. JPOW not doing anything with the rates, and we close the week like
full
maybe
beating.
like 4,200. Here, I'll make it like blue. That's what would happen with the bull projection.
Let's say 42.50. Give it some juice, man.
Give it some juice. All right.
I mean, short calls could get squozed, right?
Can they? Most of them are too far out of the money.
I guess that's true, but they could get scared.
I mean, yeah, they're still selling like all the short call theta is above delta neutral still, and I don't think we're gonna see delta neutral this week.
That'd be insane.
Yeah, that'd be fucking nuts. I mean, if we do, I'll make a shitload of money buying a call at literally any point, right?
Yeah.
All right. So there's the projections, guys. Thank you so much for hopping on.
Yep.
I appreciate it.
Surprise, we're bearish.
Thanks for having us, bud.
You got it.
All right.
I'll
see
see you
ya.
guys. I'll see you guys later today. Actually,
Oh
Yeah.
yeah.
yeah,
We got a little quant session.
yeah, mutual rubbing to do with each other.
Love it.
Me too.
All right.
All right. Later, guys.
Take it easy. Bye.
All right. I don't know if I missed anybody's questions. I probably did. And if I did, hit me up with a DM over on the Discord. I'll try to get it answered for you. Pickles Picks will be out tonight, probably around midnight to 2 o'clock, somewhere in there. But make sure at least to check them in the morning before market open. Thank you guys so much for tuning in. I'll leave the VOD up in case you got blown out by the shitty YouTube server problems today. And I'll see you guys tomorrow. Have a good night, everybody. Later.